Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Thursday, July 2, 2026. We're Elena and Marcus.
And we've got quite the tape to unpack today.
Yeah, we really do. I mean, imagine leasing a massive, incredibly expensive office skyscraper, right? Only to immediately stick a for rent sign on the front door to try and, sublet the top floors.
Right, which is basically what we're seeing right now.
Exactly. That is essentially what one of the biggest tech companies in the world just signaled they might do with their massive AI infrastructure. And it's setting shockwaves through the market today.
It really is. The ripple effects are everywhere.
Yeah. So looking at today's data deck, we are tracking 4 critical themes that are aggressively reshaping the cross-asset landscape. First, a severe U.S. labor market shock that's violently repricing near-term Federal Reserve rate expectations.
That's a big one.
Second, we're seeing a massive momentum unwind and a brutal capital expenditure reality check, specifically battering the semiconductor and AI sectors.
Right.
Third, this is resulting in a deeply bifurcated equity tape. We've got a record high for the Dow Jones and a simultaneous sharp plunge in the NASDAQ.
Yeah, a real split tape today.
And fourth, we are watching a major breakout in gold, fueled by these shifting macro tides.
Indeed. We are seeing the market aggressively digest a fundamentally new environment across all 4 of those vectors. Investors are realizing that the old playbooks from earlier this year, well, they might not work heading into the second half.
So let's start with the macro catalyst that kicked this whole shift into gear. Looking at our daily desk data, the June non-farm payrolls report delivered a major downside shock. The print came in at a meager addition of 57,000 jobs. That drastically misses the consensus estimate of 135,000.
A massive miss. And it wasn't just a one-off for June.
Right, exactly. We also saw significant downward revisions for the prior months.
Yeah.
Now, the headline, unemployment rate actually dropped to 4.19%, which, sounds positive on the surface. But when you look under the hood, that drop was not driven by robust job creation.
No, not at all.
It was driven by a sharp 720,000 person contraction in the labor force.
Correct. That labor force contraction is the critical detail you have to focus on. People simply stopped looking for work. I mean, a 57,000 payroll print is bordering on recessionary territory.
Yeah.
We're seeing a persistent, undeniable slowdown in the underlying pace of job creation. To give you a specific example, employment in leisure and hospitality actually declined by 61,000 in June.
Which is usually a strong month for them.
See, exactly. That directly reflects weaker than usual seasonal hiring. Companies are just pulling back.
And the market reaction in global rates was immediate. The 2-year Treasury yield, our most policy-sensitive tenor, it fell 4.1 basis points to 4.139%. Swap traders essentially looked at this labor data and completely collapsed their near-term hike bets. They pushed any probability of Federal Reserve tightening all the way out to December or maybe even March of next year.
Yeah, they aggressively repriced that front end.
But here is where I get a bit tripped up looking at our latest run. The 10-year yield did not follow suit. The 10-year yield actually held firm at 4.486%, so it was up 0.6 basis points on the day. And that specific dynamic caused the 10-year, 2-year yield curve to steepen. It's now sitting at a positive 35 basis points.
Yeah, that steepening is key.
So let's use our first principles rule here for a second, because this is crucial for anyone managing their own bond exposure. If the labor market just delivered a recessionary print, and short-term rates are plunging because the market thinks the Fed is going to back off.
Right.
Why does a falling 2-year but a flat 10-year mean the market is not actually pricing in a recession yet?
Yeah.
Walk us through the underlying mechanics of that.
Understood. It comes down to what each specific bond duration is actually measuring. The 2-year yield is heavily tethered to what the Federal Reserve is going to do in the immediate near-term future.
Okay.
When payrolls miss so severely, the market instantly assumes the Fed is on hold for longer. So the 2-year yield drops to reflect that looser short-term policy.
Right. That makes sense.
However, the 10-year yield is a different beast entirely. It reflects long-term economic growth and long-term inflation expectations.
So it's looking much further out.
Exactly. If the broader market truly feared a genuine economic collapse, like a severe, capital-destroying recession, investors would immediately panic and flood into the ultimate safety of the 10-year Treasury.
Right, a flight to safety.
Right, and that massive wave of buying would drive the 10-year price up. And because price and yield move inversely, it would drive the 10-year yield aggressively down.
I see.
Because the 10-year yield held firm today, it sends a very clear signal. The market is treating this labor data as a reason for a delayed Fed, not a catastrophic growth scare. What we call the term premium, the extra compensation investors demand to lock their money away for a decade. It's holding steady. Investors still believe there will be long-term growth.
That makes perfect sense when you break it down like that. It's essentially the market saying, the Fed will pause, but the sky isn't falling.
Exactly.
And we see that exact same macro repricing playing out in foreign exchange today. The DXY, the US dollar index, slumped roughly 0.5% today.
Yeah, quite a drop.
It's its largest daily decline since early May, purely driven by that collapse in near-term rate hike probabilities.
Right.
Lower rates make the dollar less attractive to hold. Yet, despite the dollar weakening broadly, the US dollar to Japanese yen pair, the USD-JP, remains highly elevated at 161.9.
Right.
That keeps the Bank of Japan intervention risks acutely in focus. Our daily desk data suggests institutional traders are on extremely high alert right now for untelegraphed, targeted campaigns by the Ministry of Finance to squeeze speculators and prop up the yen.
Moving to today's data in the credit markets, we are seeing a clear confirmation of this exact macro environment. Our latest run shows a very strong preference for the 5 to 7 year duration segment in US dollar investment grade credit.
So they're targeting the belly of the curve.
Correct. If the Fed is moving to a prolonged pause, that specific belly of the curve offers the best risk-adjusted carry for investors. However, there is a major bifurcation emerging that we need to monitor. Long end spread curves for the technology, media, and telecom sector, specifically the 1030s curve, are steepening.
And to clarify that metric for everyone, the 1030 steepening means the yield difference between 10-year corporate bonds and 30-year corporate bonds is getting wider.
Right, exactly. And this is happening directly due to the heavy volume of long-duration AI debt issuance hitting the market.
Well, because of all the data center builds?
Yeah. Tech companies are issuing massive amounts of 30-year debt to fund these expensive AI data centers. They're flooding the market with supply and pushing those specific long-term yields up, whereas, non-financial sector curves are actually flattening.
Which brings us to a massive paradox in the equity markets today. I mean, if short-term rates just dropped and the Fed is delayed, traditional market logic dictates that high-growth tech stocks should have rallied hard today.
That's a standard playbook.
Right. Lower interest rates mean future tech earnings are worth more in today's dollars. That is standard finance theory. But instead, the tech sector cratered. The entire cross-asset narrative completely fractured.
On that point, the equity tape literally split in two today. On one side, you have the Dow Jones, which surged positive 1.14% to hit an all-time record high.
Yeah.
That index was lifted heavily by rate-sensitive cyclicals and defensive stocks that directly benefit from falling short-term rates.
And on the other side?
On the other side, the NASDAQ 100 tumbled negative 1.61%. Meanwhile, the Russell 2000 also fell, dropping negative 0.55%. The Russell's weakness is driven by a combination of broad valuation concerns, negative earnings revisions, and its remarkably high exposure to floating rate debt. Since floating rate debt becomes more expensive to service if rates stay higher for longer, smaller companies get squeezed tightest.
If you are holding a standard tech ETF in your portfolio right now, the specific corporate catalyst driving that NASDAQ plunge is the reality check you need to be paying attention to.
Yeah.
Today's proprietary updates show Meta exploring ways to monetize its excess AI infrastructure by potentially becoming a neocloud provider.
Right.
Going back to that analogy we started with, Meta essentially leased a massive, incredibly expensive computing skyscraper to train their AI models, and now they were suddenly trying to sublet the floors they aren't using.
Yeah, exactly.
It sends a glaring signal to the broader market that we might have finally hit peak infrastructure demand, and these hyperscalers just have more capacity than they can actually deploy profitably.
Indeed. And the market is absolutely ruthless in how it interprets these signals. Prior to this headline hitting the tape, Meta's shares had actually underperformed the NASDAQ by roughly 30% year-to-date.
Right, they were already lagging.
Exactly. The market was already deeply questioning their massive capital expenditure budget. Whether Meta actually successfully rents out that server capacity to third parties is almost secondary at this point.
It's the signal it sends.
Correct. By showing a willingness to monetize idle infrastructure, they're signaling a return to capital discipline. We are shifting forcefully from an era of unbridled, unquestioned infrastructure spending to a phase where the market is strictly demanding tangible return on investment. The laws of reflexivity are at play here.
Unpack reflexivity for us in this context.
Yeah.
How does that feedback loop actually work between the stock price and the company's spending?
Understood. Reflexivity is the concept that market perception actually dictates underlying corporate fundamentals, and vice versa.
Okay.
Over the last year, the market rewarded companies for spending billions on AI chips, so companies spent more.
Right.
But now, perception has shifted. The market believes the spending is wasteful without immediate revenue attached, so the market punishes the stock price.
I see.
To fix the stock price, management is forced to cut spending or find new revenue streams like this neocloud idea. You cannot spend indefinitely without showing returns because the market simply will not provide the capital to let you do it.
Right.
Meta surged 8.8% today on massive 161% excess trading volume, specifically because investors rewarded that newfound discipline.
But the knock-on effect of Meta's capital discipline was absolute carnage for the global semiconductor sector. I mean, it is a zero-sum game.
Oh, yeah.
If hyperscalers like Meta have overbuilt and they are cutting back, the forward demand for the actual physical chips drops significantly.
Yeah.
The reaction was severe. Micron dropped 11% overnight and closed down 3.1% in the U.S. session. SanDisk fell 9%.
Huge moves.
And looking at the Asian markets, SK Hynix fell 14% and Samsung fell 9%, which dragged the entire KOSPI index down nearly 8% today.
Yeah, a brutal session for the KOSPI.
And adding even more pressure to merchant vendors like NVIDIA, reports surfaced today that Anthropic is in early-stage talks with Samsung to develop their own custom AI chips.
Correct. That Anthropic development introduces a severe, multi-year vertical integration risk for the chip makers.
Right, bypassing them entirely.
Exactly. If the frontier AI labs decide they don't want to pay high margins to merchant vendors and start designing and building their own silicon, the overall profit pool for the current semiconductor darlings shrinks dramatically.
Right.
And this fundamental shift triggered a historic positioning unwind today. Our daily desk data highlights an 18% two-day drawdown in the high beta momentum factor, which trades under the ticker GSPRHIMO. For context, that factor tracks a specific basket of stocks characterized by high volatility and rapid upward momentum. An 18% drop is the steepest two-day decline for this momentum factor since the COVID crash.
That positioning data really explains the sheer violence of the move we saw today. Prime brokerage data reveals that momentum exposure remains a highly crowded trade.
Very crowded.
It's sitting at close to 60% of fund equity. When a crowded trade like that unwinds, it forces mechanical, algorithmic liquidations. Hedge funds aren't just taking profits. They are exhibiting a definitive risk-off posture right now.
Yeah, they're heading for the exits.
In fact, they net sold global equities in June for the first time in 3 months, and they are actively rotating out of the technology, media, and telecom sectors and moving that capital into cyclicals. We're seeing stark evidence of this rotation in ETF flows as well. There was roughly $1.3 billion in ETF outflows from the software sector in June. That is the largest single-month redemption since 2018.
Huge outflows.
Contrast that with financials, which showed strong resilience today. We saw heavy long buys and specific regional upgrades like EB Financial being added to regional conviction lists, heavily outperforming the broader market.
Moving to today's data regarding the hardware supply chain, we also have to monitor the severe bottlenecks in high-bandwidth memory. Apple is currently lobbying the U.S. administration for greater access to Chinese memory supply due to these global constraints.
And strictly looking at the structural economics of that lobbying effort, it heavily underscores how severe these supply chain bottlenecks have become.
Definitely.
Apple is emphasizing to the administration that these hardware constraints are pushing consumer electronics prices materially higher across the board. It is a fundamental issue of supply and demand concentration that, governments, enterprise customers, and competitors are all highly incentivized to solve as quickly as possible.
On that point, an ever-growing share of total AI industry profits is currently accruing to just one or two commodity bottlenecks. That level of concentration is structurally unsustainable for hardware margins over the long term.
Right.
It adds yet another layer of fundamental pressure to the semiconductor space, which is exactly why we saw the aggressive selling today.
So if the tech sector, which has been the market's undisputed darling for the last 18 months, is facing this intense ROI reality check, and the labor market is clearly softening, capital has to find a new home.
It has to go somewhere.
Exactly. We are seeing that money aggressively seeking alternative stores of value. Let's look at how commodities and hard assets are absorbing these flows.
Gold was unequivocally the session standout today. Gold surged positive 2.25%, breaking out to $4,135.50 per ounce.
I want to push back on that gold move for a second, though, because it seems entirely contradictory to the broader institutional sentiment.
Okay, how so?
Based on our internal research, the institutional consensus recently downgraded its December 2026 gold target from $5,400 down to $4,900 per troy ounce.
Right, I saw that.
And that downgrade wasn't just talk. It was corroborated by massive ETF redemptions. We tracked $13 billion in outflows in March and another $5 billion in June. So why is the gold market completely ignoring that massive institutional downgrade today?
Understood. It comes back to the macro catalyst we discussed at the top of the briefing. That institutional downgrade was entirely predicated on the assumption of a highly resilient economy and delayed rate cuts.
Ah, I see.
Today's 57,000 payrolls miss completely inverted that core assumption. Gold yields nothing. It doesn't pay a dividend, so it is highly sensitive to real interest rates.
Right.
Today, gold is purely reacting to the drop in those real interest rates and the dovish Fed repricing triggered by the weak labor data. Furthermore, there is currently a record $7.95 trillion sitting in money market funds right now.
That's a massive wall of capital.
Correct. As short-term rates begin to fall and the yield on those money market accounts drops, that capital is looking for deployment. Gold is functioning today as a clean, highly liquid macro expression of lower real rates and a structurally weaker U.S. dollar.
Looking at the rest of the commodity complex, the moves were far more muted. WTI crude gained positive 0.54%, closing at $68.46 per barrel. But our proprietary updates note that the upside there is strictly capped by the ongoing U.S.-Iran de-escalation narrative.
Right, the geopolitical risk premium is draining out of the oil market.
Yeah. Copper edged up positive 0.33%, but silver actually lagged the broader precious metals rally, gaining only 0.29% today. And the reason for that lag perfectly ties back to our tech discussion. Silver plays a dual role. It is both a monetary metal that investors use as a store of value and an industrial metal heavily used in the manufacturing of the very microchips that are selling off today.
Indeed. The divergence between gold and silver today perfectly encapsulates the dual narrative driving the broader market. The purely monetary metals surged on the Federal Reserve repricing, while the industrial metals stalled out due to its direct ties to the technology sector's weakness.
So when you put all these pieces together, how do we connect the dots? We have a dovish rate repricing driven by a severe labor shock. We have a brutal historic momentum unwind in AI and semiconductors. And we have a strong bid for hard assets and cyclical equities.
Yeah, it's a lot to process.
What does this cross-asset synthesis actually tell us about the broader economic regime we're entering?
Synthesizing today's proprietary updates, the cross-asset message is becoming remarkably clear. The broader market is desperately attempting to price a soft landing.
Okay.
Short-term rates are falling, the Dow Jones and gold are rising, and broad credit spreads are tightening. That is standard textbook behavior when the market expects the Federal Reserve to successfully navigate an economic slowdown without causing a deep structural recession.
Right, the Goldilocks scenario.
Correct. However, the critical takeaway today is that the AI and semiconductor sectors have completely decoupled from that broader macro environment.
They are essentially operating on their own isolated island right now, completely detached from what interest rates are doing.
Correct. The tech sector is undergoing its own isolated reckoning regarding overcapacity. The era of blindly buying every AI-adjacent winner is officially over.
Yeah.
The market is demanding strict capital discipline. If hyperscalers cannot justify their multi-billion-dollar capital expenditure budgets with tangible returns, the market will punish their stock price, regardless of whether the Federal Reserve cuts interest rates once, twice, or 0 times this year.
For those of you tracking these shifts and looking at your own portfolios, what are the key indicators to watch in the immediate term to see which of these narratives ultimately wins out.
You must watch the 10-year Treasury yield incredibly closely tomorrow.
Okay.
Today, it closed flat. If
Okay.
it begins to aggressively rally, meaning the actual yields fall sharply, the narrative shifts instantly from a benign, helpful Fed pause to a genuine recessionary growth scare.
Because they'd be buying bonds for safety.
Exactly. The market would be signaling that a 57,000 jobs print is not a seasonal anomaly, but the definitive start of an economic contraction. Additionally, keep a very close eye on ASML earnings on July 15th. As a primary equipment supplier, their forward guidance will be a critical, undeniable indicator for global semiconductor capital expenditure, specifically regarding their capacity plans for 2027.
Let's do a rapid recap to tie it all together. A severe 57,000 payroll miss has pushed out Federal Reserve hike expectations. That sparked a defensive rotation that pushed the Dow Jones to a record high and triggered a major breakout in gold as real rates dropped. Simultaneously, Meta's pivot toward monetizing its excess infrastructure through a neocloud model has triggered a massive momentum unwind in global semiconductors, forcing the market to finally demand tangible ROI from the AI sector.
I will leave you with a final thought to mull over as you review your exposure this week. If Meta can successfully transition its idle, excess computing capacity into a neocloud provider to recoup costs, is it unimaginable that the frontier AI labs themselves could eventually do the exact same thing?
Oh, that's a good point.
If these heavily funded labs begin renting out their own excess compute to third parties, it could fundamentally disrupt the entire hardware supply chain by drastically reducing the need for anyone to purchase net new silicon.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market color. Happy 4th of July. Make sure to enjoy the World Cup matches this weekend.